Well, good afternoon. We wanted to thank you for joining us for today's Business Valuation webinar, what you can do to enhance the value of your business. I'm Eric Blocher, Partner and Director of Business Valuation Services at McKonly Asbury. And joining me today is Dave Blain, Partner and Director of Entrepreneurial Support and Client Accounting Segment. For those of you who don't know, McKonly Asbury is an accounting firm and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We provide a range of services to organizations across a wide variety of industries. And as you can see on the screen, oops, let me get to that screen.
Eric, you good there? You got the controls?
I'm trying to get the controls now, but there we go. Okay.
There, a great looking picture of you, Eric. You look good.
I don't know. Right, I've never taken a great picture in my life, Dave. Don't.
Nah, you look good. You look good. You look good.
Okay, now there's the services. There's the services. Don't ask me to chew gum and walk at the same time. If you've joined us in the past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. And you'll note that CPE polling questions will be popping up on the screen throughout the presentation. And if you have any questions for us, post them in the chat feature, submit them, and we'll try to question them as we can. We'll do our best to answer them during or after it. And for those of you that are looking to obtain CPE credit, please keep in mind there will be 4 polling questions throughout the presentation, and you'll need to answer all 4 of those questions to get your certificate via mail or email in a few weeks after the webinar is done.
Yeah, that's really important, Eric, too. I mean, let's be honest, make sure that you answer all 4 polling questions. So I was going to just say, Eric, why don't you launch that first question?
I certainly will. This one's easy. You get a 50-50 chance of getting it right. Do you wish to receive?
Actually, I don't think there's a wrong answer here, right?
I don't
maybe
think
some people just want to hear you, Eric.
Oh, goodness gracious. I feel bad.
Anyways, if we'll give everybody about 30 seconds or so to answer this question, the polling question here, and we'll go ahead and get started. All right, 89%, Eric, are here for CPE. So pressure's on that we deliver some good CPE here today.
Yeah, we might have a lot of disinterested listeners, but they'll come out knowing more at the end of the day. I know
there we go. There we go.
Okay, our agenda and objectives for today. We're going to identify key areas and variables which impact the value of your company. We're going to identify steps a company can proactively take to increase their value. And we're hoping that you will gain an understanding of the impact that the economic and other non-controllable factors can have on the value of your business. And we'll be giving you miscellaneous other information as the webinar goes along to help support these objectives.
Absolutely, sir.
Okay, the first part of it is going to be an introduction to business valuation. And this is going to necessarily be a 30,000-foot view down on valuation. I'm a firm believer in that as a business owner, you should understand some of the basics about business valuation because that will help you understand how one works. And then ultimately, it'll allow you to understand better how you can impact the value of your business. So the first thing to consider here is that business valuation, it is no different than any other investment decision. That's something I always tell my clients when they're looking at trying to determine the value of their business. It's to look at it from an investment decision or as a buyer of it. And in every investment decision, there are 3 factors that are considered. The first one is the amount of return that you receive on the investment, and it's always cash flow. And Dave and I have said frequently to our clients, and there's no adage out there.
Cash is king, right?
Cash is king, and that is so true. It is.
Yep.
They're always concerned about the cash flow. The second thing that's factored into every decision is the risk of not getting that return. Certain businesses and investments, they're riskier than others. And you have to factor in the risk of not getting the return into the eventual price that you want to do for it. So the risk is captured in valuation, is captured in the discount rate or the required rate of return. And then the third thing that's always factored into every business valuation is the time period over which you'll receive your return. I remember growing up, I got a weekly allowance, and getting my weekly allowance on that day was much more valuable to me than waiting to the end of the week. And that's the same in business valuation and investment. $1 today is worth more than $1 3 years down the road. So you always factor the time period where you're going to get it into the investment decision. And business valuation analyzes and addresses these three factors.
Yeah, Eric, absolutely. And the cash flow matter is really the key matter to really understand there. And that's got to be some of the main items that we're going to talk about today is, how do we improve that cash flow and that cash flow modeling to be able to take advantage of your return, the return period. So
yeah, and once again, we want to highlight that it's cash flow. If you're familiar with your financial statements, the bottom line number that a lot of people think of is net income, and that is not necessarily cash flow. To get at the true value of a business, you need to look at the cash flow, which considers capital expenditures, working capital needs. It adds back non-cash expenses like depreciation. So you're really looking at the bottom line cash flow instead of the net income number.
Absolutely.
Yep. And an essential tenet of business valuation is that it's forward-looking. It's the expectation of future cash flows. You can look to the past of your cash flow to get an indication of the future, but the valuation is always going to be based on future cash flows. A good example of this, if you go back, unfortunately, to the COVID-19 era, and I did some valuations right up at the end of 2019 and even the beginning of January of 2020, and then the outlook changed dramatically from January of 2020 through June of 2020. An example would be restaurants. Do you think the outlook changed for them between January 2020 and June of 2020? And it was yes. So the future expectations of cash flow would change. So the time frame you're doing evaluation can have an impact on it because the future expectations can change dramatically. An investor or buyer, they'll look at the estimated cash flow returns and the risk of getting them. And like I said, with the COVID-19, both things can change quickly. And then the time value of money is always considered. I mentioned that a little bit earlier. The present value, like I said, $1 today is worth more than $1 next year.
Yeah, and again, going back to the time value of money, Eric, that is, we talk about that a lot, right? Where that the value of that dollar today is going to be worth more than it's going to be in the next couple of years. So that's why looking at some of the things and concepts we're going to talk about regarding the value of your business are going to be important, because that's going to help strengthen that dollar value today versus what it might be a couple of years down the road. So
well, an example of that, if you look at it, is every business usually looks to accelerate depreciation. Why? Because they want to save tax dollars today, and they're not worried about it so much in the future.
Absolutely.
So that's a practical application of it.
Absolutely.
Okay, now this next slide.
Here's one of your favorite ones, Eric.
Oh, it is.
Gordon growth model. I mean, I'm excited to hear you talk about the Gordon growth model.
I have been accused of being a valuation nerd, and that is very true. But what this slide will do is it should present as an overall example, and importantly, I want to kind of look at the equation because it presents two things. This is the Gordon growth model, which is a way of looking at valuation and present value, where the present value of your company is worth the expected cash flow in period one divided by the risk-adjusted discount rate, which is your required rate of return less the expected long-term growth. But to keep it simple, and this is what you want to think of, is there's two parts of this equation. And this equation is used in some form in every valuation. The top part of the numerator is the cash flow. You can impact the cash flow to change the value of your company. And then you also have the denominator, which is the required return and the risk. And you can impact that also to change the value of your company. And then something that we'll be going on to later is that sometimes the required rate of return, there are factors that impact that you have no control over. So understanding those things can help you get some expectations about your business going forward.
Yeah, actually, that model there, while it might sound complicated, it's relatively simple to understand when you think about it. That the numerator is going to be cash flow, the denominator is going to be the things like your rate of return, and other factors. And that's really, so we talked about that a little bit earlier here as you were going through some slides. This is just kind of putting it on paper to see what that formula actually looks like.
Yeah. So following that formula, if your cash flow of your business increases, the value of your business increases. And that makes sense. If you have more cash flow, it's more valuable. As growth increases,
right?
Yep. As growth increases, value is going to increase because that's going to be bigger cash flow, bigger value. But as the required return increases, that's increasing the bottom number, values decrease. And that's something, there are inputs into the required rate of return that you have no control over. And then part of it is risk. Risk increases the required rate of return, and most businesses have more risk than they realize. So an overlooked way to increase the value in your company is to decrease the required return, and in particular, the risk that's associated with your business. And that's something that we find is very beneficial, and we've seen it come into play when Dave and I have worked on transactions where due diligence is done, and the company that's buying is looking at risks associated with the company that they are buying. And so the lower the risk, the lower the higher, the lower the required rate of return, and the higher the value of the company would be. So when a company wants to increase its value, they typically focus only on the numerator, and that's the cash flows. And then there's nothing wrong with that, but they focus on increasing sales. They focus on decreasing costs. Those are the top two I hear in every presentation that I've been to about this. Those are the first two things discussed. Let's increase sales. Let's look at decreasing costs, and that's the low-hanging fruit. They focus on reducing debt. Sometimes they eliminate underperforming sectors of their business, and that's not a bad thing to do. All of these are good, but they sometimes focus on earnings and net income, which I mentioned earlier, instead of the important measure, cash flow. So there are things that you can do that can impact cash flow going forward, and that's what we're going to be.
Yeah, Eric, I just want to emphasize too, the items that you have listed out here: increasing sales, decreasing costs, reducing debt, eliminating underperforming sectors of your business. They're all things that you should be doing all the time with your business. You should be assessing areas that you can increase your opportunities, that you can decrease your liabilities or your costs. So you should be doing that all the time. It should be part of the everyday aspects of your business. However, you just want to be cautious that you're not doing things there that are going to have longer term impacts that are going to negatively impact the value of your business.
Dave, it's almost like you looked at the next slide.
Yeah.
I'm telling you.
There we go.
As we go. All of these things are good practices if done in the correct manner. However, there's certain things that you want to think of while you're looking at this. Increased sales without adequate infrastructure, it can be a disaster in the long term. You can't grow at all costs if your company can't handle the growth efficiently. I have seen several businesses that I valued where their top line sales number has been increasing and their bottom line net income and cash flow has been decreasing because they didn't have infrastructure and they couldn't handle the sales. They had to hire additional labor and the labor wasn't fully utilized. You really need to look at this and to plan things out and to model things out. Decreasing the wrong costs can hurt your ability to compete then too. You could have fixed costs where you don't need them, and then you can't price your goods the same way that you might want to just because you've increased certain costs more than you need to.
Right.
Any other thoughts on that, Dave?
I think you hit the nail on the head there, Eric. Again, it just comes down to you got to be cautious in regards to you want to every day should be managing your cash flow. You just want to be cautious on what you're doing that could have potential long-term impacts to your business.
Yeah. Okay. And as I mentioned before, don't forget to look at the denominator. That's the bottom number, the risk.
All right. I think we're on to our first polling question, or second polling question, right, Eric?
Yes.
Eric,
Second
you did a nice
polling
job. You've done a nice job with these polling questions, by the way. I'll give you a lot of credit there. So, which of the following do you think is the greatest Pennsylvania mascot? Now, I know there's many mascots out there, but Eric and I kind of really tried to boil this thing down. Is it the Flyers mascot, Gritty? Is it the Phillies mascot, the Fanatic, or is it the Nittany Lion at Penn State? I mean, really, they're synonymous. All three of those mascots are synonymous with their organization. So, be interested to see what the polling question or how the polling responses come back on this one. Eric, which one's yours?
You know, at some point, I was either between, you know, B and C. You know, I was either between the fanatic or the Nittany Lion. But for me, I think it's got to be the fanatic.
Okay.
I go back a long time, and I remember, you know, him getting beat up by Tommy Lasorda and riding the four-wheeler around Veterans Stadium.
Yeah.
Well, there's a tie. Okay.
Look at that. We have a tie between the fanatic and the Nittany Lion. Mine would have been the Nittany Lion. I mean, I think that's a long-term mascot right there. Kind of synonymous in Pennsylvania, but wow, tied between the fanatic and the Nittany Lion. That's pretty cool.
And that surprised me. Cool. I honestly thought you were going to be Gritty, Dave.
Well, I do like my Gritty. There's no questions asked about that. But Gritty's new to the scene. He's new to the scene.
He is. He's a new, but he's an up and comer.
He's an up and comer. All right. Well, let's talk a little bit more about. Let's get away a little bit from the actual mechanics of valuation and talk about some of the concepts and things that we do look at in valuation that are drivers of value, that are things that if you're selling your business, the acquirers probably items that they're going to look at in regards to how to continue to increase the value of your business. So if you can advance there a second there, Eric, to the next slide. Yeah, so when we talk about value drivers, we're talking about value drivers and activity or capability that adds worth to a product, service, or a brand. So this could be something that could be unique to your business, could be unique to your organization. Maybe it's a niche product in your business. Focusing on some of these drivers can provide benefits to both what Eric was talking about with the Gordon growth model, the numerator and the denominator. Some of these benefits obviously are going to be impacting cash flow, but it's also going to impact things such as potential rate of return and potential risk that's involved with the business. So if you're an acquirer looking to purchase, these would be some things that you're, part of your due diligence is definitely going to look at. If you're positioning the company for sale, or if you just want to increase its value, elevate these value drivers in their risk from the buyer's perspective. Again, this is going to be things we're going to talk about that may sound pretty basic, but sometimes they get lost in the equation in regards to how you look at your business.
Yeah, and value, they can be very and different for every business. We're going to list a bunch here, but there could be other ones that, your business could have a fantastic location for something, that is convenient to the city for your restaurant, that everyone goes there because you're the only place in downtown. That could be, your location could be a value driver. You might have a product that is has all the bells and whistles. It's better than something new that you've developed is better than anybody else out in the market right there, and that could be a value driver for your company.
You might have a patent or a trademark that nobody else has, and you have the leverage and the luxury of having that. So we're going to look at a couple, more than a couple of things that we think when we look at valuation do drive value in the business. So if you want to advance there, Eric, the first thing, a lot of it, especially if it's an organization maybe like private equity, it's coming in, they're looking for a turnkey approach. So having a strong management team in place first and foremost is going to allow for that continued aspect of the business, continuation of the business. So constantly looking at your management team, what your management team's doing, the length of service of your management team, how experienced they are. That's going to be some things right there. Just in general, when we look at valuation and we look at valuation concepts, Eric, we're looking at premiums or discounts on the strength of the management team. So it's, again, something that you need to pay attention to.
I've been approached by several companies that are looking to transition ownership from possibly the original owner, to next generation or another owner, and several have had different answers to this question and the point we raise here. One of them had a strong management team that they were comfortable looking at different options because they knew it was there. And then I've talked to a couple businesses that realized that they did not have the strong management team there. So what they had to do is they had to develop it. They had to postpone a transaction, because they didn't really feel it once they left that there was a strong management team in place that could assist the new owners. So, in a worst case scenario, not having this available, increases the risk and sometimes moves the transaction further away because you don't have that team that can take over for what you're doing.
Right. Same thing with documentation of processes and developed business systems. Again, having those things in place that an organization can come in and almost have it as a turnkey approach to acquiring this business and to keep it up and running and to be able to cash flow it immediately. Having documented processes and business systems are really kind of key to that whole concept. Diversified customer base and recurring revenue. I just think about our audit practice, right? As a firm, one of the things that we look at is concentration of risk. Is the business tied into just 2 or 3 customers, or does it have a long list of customers that have smaller amounts of the revenue that are being generated from each customer? Again, having heavy concentrations in 1 or 2 customers, or having heavy concentrations in 1 or 2 business lines does create some additional risk. So being able to diversify those business lines and create recurring revenue streams, that's value added, because you look at it from the perspective of a buyer. They're looking for the ability to cash flow it right away. They can cash flow it right away with recurring revenue streams, and you can cash flow things right away if you have a good diversified customer base that insulates you from economic downturns, or can insulate you from some potential things that might happen in the market that you don't have control of.
Yeah, there are 2 separate points under here, but a diversified customer base, that's one thing that I look at in every valuation that I do, is if there is customer concentration. And I look at how much revenue, top 5 revenue customers for the last 5 years, and see how much that's concentrated. It's a little bit of a double-edged sword, because as a business owner, you're trying to get, people to get more of your product. And it's not a bad thing necessarily if you have, 50% of revenue comes from one client. There's some risk there, to some degree. But then also, if you can say, hey, we've had this client for 25 years, we are intimately involved in their production process, we supply them with things that no one else can, then it's a positive to some degree.
Exactly.
But you have to look at it to see. But if your revenues come 75% from a government contract that comes up every 3 years, there's risk there. It can't be denied. You might be the benefactor for those 3 years, but what happens if you don't win the contract? Your value of your business can go way down. And then reoccurring revenue, like Dave said, it's another thing. That's like the golden ticket to some degree. It's not where you have to go and eat what you kill as a business each year. These are revenue streams that are predictable. You know how much it is, and it's easy to forecast, and it gives comfort to the buyer and less risk when you're looking at the company. The more reoccurring revenue that you have.
Yeah, minimizing supplier risk too. That's another thing. We saw heavy impacts to valuation during the COVID period, or the COVID area, because of the supply chain disruptions, right? So trying to minimize those risks by having multiple suppliers of the same product, looking at where those supplies are coming from. Is it coming from overseas? Is it domestic? Is it within the continental North America? You know what I mean? Where it can travel, where you could have different suppliers that are going to reduce some of that risk of getting the materials you need to continue to run your business. Again, matters that are looked at during due diligence, matters that are looked at during evaluation.
Exactly. An example with this would be, if you look back at the COVID period, I remember when everyone was sheltering at home, and it became impossible to find a bike. So many people were trying to buy bikes because they had time to ride, but nothing was being shipped in. Everything was being produced outside, and I had to go buy my son a bike, and I had to drive 3 hours away just to find one in stock. We ran into the same situation with the refrigerators and things like that. It's just some of the different supplies just couldn't become available. You can have microchip issues. With some of the political instability that's in the world right now, you never know what you're going to have or what's going to become scarce. So that's why having multiple suppliers and documenting it and having the story to tell that, hey, this is our primary supplier, but we have contracts to back up for this, so we don't think that we'll ever be short on our inventory. That's a good story to tell. The other flip side of that is, if you don't get it, you have to buy it while you have it, and sometimes you might have no cash to do that. you might have to extend your inventory, which isn't always a good thing then too, just to have stuff available to sell.
Yeah,
so
absolutely.
looking at the supplier risks is important.
Yeah, the other thing too, Eric, is competitive advantage. And wow, this may sound kind of like, well, yeah, I mean, I as a business owner, I need to know what my competitive advantages. You'd be surprised at how many business owners we've talked to and during our processes that really don't have a really good honed insight in regards to what their actual competitive advantage is against their competition in the marketplace. What is the niches that they're actually really good in, and how are they exploiting those niches? But being able to focus on those areas in regards to how you can drive higher levels of cash flow. It's going to also reduce your risk, because it's going to put you in a space where, if you know what those niches are, you're going to be reducing your competition, right? You're going to be reducing who you're competing against, because you're developing a niche that you're really good at, you're really strong at, and it creates barriers for entry for competition. So
yeah,
knowing that is also pretty important in regards to do that research, do that industry research in regards to what what your industry niche is, and where you compete in that industry, and what your margins look like in that industry, and utilize that for your advantage of your business from a cash flow and risk perspective.
Yeah.
Eric, can you go next to the slide there?
Okay. Well, I want to make one more comment on the competitive advantage. If you think of like Dollar General, they know how they compete. They compete on low cost, high volume items that they buy, at big discounts. So they're not trying to be the luxury provider or give high service. It's okay, you're gonna wait in a line when you get here, but you're gonna get your stuff cheap. They know how they compete, and every business should know that and stick with it. You can't be everything to everyone, as Dave said.
A couple other things too, financial performance. I just met with a client of ours earlier this week, or it could have been late last week. Weeks are starting to blend together at this point. But anyways, benchmarking your business against your peers is something that, kind of going back to competitive advantage and what we talked about a little earlier, understanding how you look, or how you are viewed in your competitive marketplace. So spend a little bit of time on that area to figure out what those performance metrics are, what that competitive advantage is, what those benchmarks are. That's going to help you make some decisions into the long term in regards to how you run your business, where you want to focus your time and attention in your business, and how you can better compete against your customers, or not customers, but better compete against your competition, I mean. So again, looking at these benchmarks, that's going to help you with things like cash conversion cycles. Understand what that is. You understand what your cash conversion cycle is.
Yeah, that's one of my favorite ratios, and not a lot of people know what it is. It basically, it's the lifeblood of your company. It's the days sales outstanding plus days inventory outstanding plus days payable. It calculates how long it takes the company to pay for the goods, generate cash from it. And you would be surprised at how widely it can vary. And there are even businesses that I value that have a negative cash conversion cycle, where their business is set up that they receive cash up front and deposits on a lot of the work. And their operating ratios are so much different, and their profitability is good because they're never really hurting for cash, because they have cash up front that they receive from it. But you can model this out, and like Dave said, the financial performance, and compare it with industry. If you don't have good industry comparables, that's when you come to your accountant, or come to companies like us, because we have that information available, can get you comparable financial statement ratios to look at. But it's just the step, starting to understanding how you perform, and then realizing that, well, someone's turning their inventory over more, or they have more working capital in hand. Why is that? Maybe because supplies might be hard to get, so they need to have more on hand. But it can give you insight into your company, and it can also point out to a potential buyer, hey, here's our financial performance. Our operating profit is 5% higher than the industry right now. That's why we're asking for a higher multiples, because we can show and document that we are more profitable than the average business in our industry.
Yeah, absolutely. And when you understand what those financial indicators are and what those benchmarking indicators are, you can do the next bullet point there, which is model future cash flows. Look at some different scenarios of what does future cash flows might look like if you were able to change some of those ratios that impact your business. And what, in order to change those ratios to increase your cash flow, decrease some of your risk, what are the internal things that you're going to need to do to be able to make those changes? So one of the ways you can do that is by doing some modeling of future cash flows. Look at some different scenarios, layer those different scenarios in, helps you to better understand where you want to spend your time in your business, where you need to spend your time in your business. Maybe that's going to flush out some issues for you, like, hey, you know what? We need to have a more diversified customer base. We don't have enough recurring revenue streams. We're too reliant upon one or two customers. How do we increase our ability to compete in a market, and then through our niches? You know what I mean? Through whatever niche products that we offer.
Yeah.
You can do a lot of that through some future modeling of your cash flows.
Yeah, and Dave and I have worked with multiple clients and assisted them with trying to do this. And whenever I talk about modeling out future cash flows, I really think it's important to model out the future balance sheets that you're looking at as well. Not just the income statements, but to look at the balance sheet, because the changes there, like the changes in your receivables, your payables, your inventory, that has cash flow impact. That's your working capital, and that changes. And it can give you a better understanding of your business, but it can also allow you to do some decision making and strategic decisions in your company. Like, what would happen if you imagine building out this model and then, okay, let's model out if we add a third shift or something like that. And you can do that, and you can see the impact on the potential cash flows that it would have. So having a good handle on modeling out future cash flows, it can give you justification for any projections that you have, and it gives you a better understanding of the impact and things that really can impact the bottom line cash flow of the company.
Okay. Next slide there. So the next couple things here really are, if you're an acquirer, these are things that you're really looking for, because it's going to give you better, it is going to give you more comfort over the operations of the business. One is scalability, showing increased profit margins and cash flows as revenue increases. This reduces risk and is highly valued by buyers, right? So just the scalability of the business, that you could scale it up. If you were to acquire it, you could do some things to scale it up to take advantage of the marketplace, take advantage of the market conditions in a very quick manner. Scalability is going to be impacted by things that we talked about earlier, like, do you have the right management team in place? Do you have the right controls and functions in place? Your ability to scale is going to be based on those items that we talked about a little bit earlier. Financial foresight and controls, again, as an acquirer, right, you're going to be doing your due diligence, and you're going to be looking at financial operations, and you're going to be wanting to look at historical balance sheets and historical income statements and cash flows and projections and models into the future. But if you don't have good, reliable financial data internally that you can provide to an acquirer, that in and of itself is going to reduce your market multiple. It will, because you're probably number one, not presenting a clear, concise picture to the acquirer, but number two, you're putting doubt into their minds in regards to what the business can actually do. Can it scale? Do you have a strain? You know what I mean? That's going to, in and of itself, reduce value for you. So just spending the right time on having the right financial foresight control is really pretty important.
Yeah, I couldn't agree more. To dig into this a little bit more, reliable financial reporting, that means, having some attest service that having audited or reviewed financial statements, that gives comfort to outside buyers. When I'm getting information from to do evaluation, I look at internally generated financial statements a lot differently than I do audited or reviewed financial statements, and I'm less skeptical.
Absolutely right. That's what I was going to get to as well, Eric, too. Like, having reviewed or audited financial statements are going to carry much heavier weight than internally prepared financial statements. Now, if your internally prepared financial statements are being prepared by an outside accounting firm like McKonly Asbury in our ESG group, whole different story. But if they're being internally prepared by a very non-seasoned accountant that may be somebody that you just hired on, and there's a lot of issues that are inside those numbers for tax preparation at the end of the year, or the accounting firm that does your tax preparation has to give multiple accounting adjustments to get the books to where they need to be able to complete a return. That creates skepticism. That creates doubt in the strength of his financial numbers. So
yeah, and then additionally, having strong controls can help prevent fraud too, which can help your cash flow, right away by not allowing that to happen. This also mentions removing discretionary and non-business expenses to show the true picture. And Dave and I have looked at enough businesses to know that there are certain personal expenses and discretionary expenses that are in businesses, and there's nothing wrong with that per se to some degree. But if you're buying and selling, if I'm a buyer coming in and I see all these add backs, oh, this doesn't need it, this isn't needed, I'm skeptical of it. Now, if you have 3 or 4 years of financial information without those type of expenses in there, it ties right in your tax return. Our report ties in there. There's none of these add backs. That to me is a much more compelling argument to say that, hey, this is the true expenses than, oh, we can reduce this salary for this, or in here are some of my discretionary expenses. I'm not taking that as gospel if I'm a buyer here. So having, like we said, all these financial foresight and strong controls, and removing excess expenses and expenditures out of the picture immediately, it is much easier picture to sell and
right.
A buyer.
Something we talked about a little bit earlier too, Eric, here, considering developing a cash management strategy. Again, this is another thing that's going to help create some value drivers. The net cash management strategy, obviously, it's going to be based on how you handle your payables, how you handle the collection of your receivables. Are you taking advantage of the opportunities to sweep money nightly if you have excess cash available? But taking advantage of those additional cash management initiatives that are out there to help improve your cash position is something that also is going to increase some value for you.
Oh, yeah.
Yeah.
Doing a cash flow projection, if you break that out by month, you'll begin to see whether you have a cyclical section or times during the year when you don't need as much cash, and you can invest it to get a higher return. But you don't know unless you start analyzing it.
Yeah,
but there are ways you can do to get a better return.
One other thing too, Eric, to kind of close this out on value drivers is quality of earnings. So we do a number of quality of earnings reports, usually on for the we'll be working for the buyer. The buyer hires us. We come in. We do a quality of earnings report on the seller. But these are things that can actually be done up front, and it can provide a lot of insight into your business by doing a quality of earnings report. If you're looking to sell, if you're going to be the seller, doing a quality of earnings report up front is going to help uncover some areas that may be, that a buyer may look at as skeptical, or might reduce the value of what they're willing to offer you. So doing something like this up front, if you're a seller, is something that is going to really provide that could really increase your multiple. It could increase your multiple 1 or 2 times, depending on how you utilize the report. But again, it comes down to cash flow, right? Every deal comes down to cash flow. Is it going to cash flow? How quickly can I get my return back? By doing this on the seller side up front in advance of the deal to help you improve your cash position or your cash modeling, it's well worth the time and expense to do this if it's going to increase your multiple, maybe 1 or 2 multiple.
Yeah, and that's an independent report. Correct?
Yes, absolutely. Yep.
I mean, it'll show things, like how much repeat, or if you have dependence on one customer, it'll look at your profitability for different, types of revenue, and it can give, a buyer a much higher comfort level with the revenue stream transferring to them. So being proactive with that, I think, is an option that people should look at.
Eric, we're at 2:40, so the next number of slides relate to economic factors. So let's go ahead and get that started and get ourselves into the next polling question there.
Okay, I will do that. Now, some of these economic factors, this is where earlier in the presentation I mentioned there are things that are out of your control. And whenever I meet with clients, if I'm fortunate enough to be doing evaluation for a client, multiple years, I like to highlight how their value changed. And I always preface it by, here's the things that have changed, that impact the value that you have some control over, but there are other factors that you don't have control over. And you need to understand that these impact value. And that's a little bit of what we're going to get into here. The broader economy, that's beyond the control of a business, and it can have a massive impact on a company's value. Each new year brings a set of risks that the company needs to address. I mean, look at what's happened in the last 3 or 4 years. With COVID, some of the political instability around the world, everything that impacts business. A good understanding of current macroeconomic environment is important to be able to prepare for and mitigate risk factors. If you go back a couple years, or back 2 years ago, the risk-free rate, which is one of the building blocks of the required rate of return, was very low. It was in low 1-2%. And as interest rates have gone up, that has gone up significantly as well. So the required rate of return goes up, values go down. Debt levels are the same thing, but people that can be proactive, and this might go towards some commodity pricing. If one of your inputs for your major material inputs is a commodity, if you understand what's going on with the market there, you can hedge and lock in your prices during times of increasing pricing. So having an understanding of what's going on in the economy and your industry, it's good because it can impact cash flow and value.
Yeah, absolutely. This is a big one right now, right? Talking about the interest rate environment.
Yep, the federal interest rate policy remains at the forefront of many people's minds. Currently projections established by the Fed on as recent as March 20th suggest that we'll see 75 basis points of rate cuts by the end of the year. And they said maybe 2 or 3 rate cuts, but interest rates impact business, it impacts lending, it impacts everyone. And it's a huge input and factor that is totally out of business owners' control for the most part. Treasury rates impact the risk-free rate. Like I mentioned before, it's used in valuations. It impacts the cost of debt. As the cost of debt goes up, the required rate of return goes up, and values go down. As I said, generally speaking, I can tell a client, I can look at last year's interest rates and this year's interest rates, and I said everything else being equal, values will go down just because interest rates go up.
Yeah, and again, you make a good point here, Eric. I mean, this is a factor here that as interest rates go up, the cost of borrowing, the cost of money goes up, and that slows down that slows down a little bit in regards to buying of capital equipment, maybe doing that new building. But as that also happens, if you're a company that is cash flush, it puts you in a pretty decent position, because if you can pay for those items and not have to take on debt, you're probably going to be in a win-win situation. Plus, you can also be in the situation where as interest rates are going up, usually deposit rates are going up as well. You have the ability to take that excess cash, sweep it at higher rates, get additional usage and additional earnings power out of your money.
Yeah, and I've had some clients that understand the inputs of interest rate and how it impacts value, and they've done some proactive estate planning because they realize as rates have gone up higher, the value of their company is going to be a little bit lower, so they're going to be doing some estate planning because they can transfer more value at a lower cost.
Right. All right, let's get on to that third polling question. Will the next valuation you have done be for estate planning, gifting purposes, litigation support, internal use such as a buy-sell agreement, or none of the above? So we'll let everybody take a minute here to go through that. And then when we get done with this polling question, we have a couple other things on economic factors that we will go through, knowing that it's 2:45 and we're kind of running up against the deadline here. But we'll get through the remaining stuff relatively quickly because it's really just more informational knowledge, if you want to put it that way, just some things to keep in mind that from the macro economy level.
Yeah, and if you have any questions, once again, don't hesitate to ask us.
Yep.
We'll try to answer them.
So I think by now everybody's probably answered. We'll give everybody 5 more seconds. I see our producer, Audrey. I'm going to give Audrey a shout out. How you doing, Audrey? Thank you very much for your time as the producer of this webinar. So she gave us the nod, like we're going to close this poll down. So let's close it down and see what the results are. None of the above, 56%. So it could be something else other than what we've just talked about, Eric.
Or so, sadly, they won't need evaluation, and I'll cry my way home then.
Eric, I've never met a person that has more passion for evaluation than Eric Blocher. So
it's a blessing to like to do.
Let's go through some additional things on economic factors real quick here, and we'll close this thing out. Supply chain disruptions. I think we just had a very, very good example of what that could potentially do here in the last 48 hours with the with the cargo ship hitting the Francis Scott Key Bridge. That shuts down the 7th largest port in the United States for the time being until they figure out what to do there. And but that already is being discussed as a major supply chain disruption matter right here in the United States. Your cargo ships can't get into that port. They're going to have to be redirected. And then you're going to have the situation of whatever is supposed to go to that port now has to be shipped from whatever new port that it's going to. So it's going to cause some delays. But that's a classic example of where supply chain disruptions can create some problems for you. We also know what's happening over in the Middle East in regards to the, what's happening in the Suez Canal in that area. But, it's just, again, there's a classic example of risk that can occur from supply chain disruptions.
Yeah, last week, businesses in the Baltimore Harbor looked a lot different than they do right now.
Exactly. Let's move on to the next one there, Eric. Fluctuations in the price of the dollar. Again, right now, the U.S. dollar depreciation against other currencies can cause material sourced from other countries to be more expensive. So the way that the dollar fluctuates against foreign currencies up or down clearly is going to could cause some volatility in the marketplace, right? Plain and simple. That's something that we keep an eye on when we do valuations. Actually, how is the dollar from a strength position against other currencies and other currencies?
Yeah, look at the companies. How much of their sales are domestic and how much are foreign.
Yep. Next item is obsolescence caused by advancements. We see a lot of this. Yeah. Now you're giving everybody, you're giving some of our polling question away. Obsolescence caused by advancements is clearly another thing that is, I think technology is something that is continually evolving every day. It goes faster and faster every day, and being up in front of those different technologies that might impact your industry is kind of key and critical. So, and making sure that you are ahead of the curve in regards to technology advancements, and you don't have obsolete technology is clearly something that, from a macro level with your business, will be, is a value driver. Artificial intelligence, clearly something that is out there now that is, a lot of industries are now starting to use. Something that is being widely used across many industries is something to keep in mind too. How that might impact your industry, how you can utilize artificial intelligence to improve your systems and operations. Next one, community and regional banks. This is a good one here, Eric. I mean, what we're talking about here is relating to maturities or portfolios that are being held by these banks. How that impacts the marketplace, how that impacts realized gains and losses on bonds, and what those, if you're holding bonds as an organization, how that might impact the value of your organization. I think the one thing I really was interested to hear more about, Eric, if you have any additional comment on this, is the New York Community Bank that appears to be vulnerable because of the profile of its because of the profile of what it's holding in its assets.
Yeah, this is one that's subject to the interest rate risk that impacts businesses, can really impact banks. If they have real estate loans that are underperforming now compared with the current rates, it can put them behind because they're receiving interest at a lower rate than what they have to pay out. And this is a bank that appears to be in trouble. And as banks can fail or get bailed out, that impacts the economy, it impacts the market, it impacts everything.
I think the key takeaway for a business owner out of this, though, is the last bullet point there. Whatever you do, make sure you understand the FDIC insurance levels, or if you're using a credit union, whatever the NCUA's insurance levels are, because you want to make sure that you got good coverage regarding whatever you have invested into that bank or whatever the bank is holding of your assets. That might mean that you need to diversify with different banks. Maybe have multiple banks involved with your organization, so you can spread that cash out if you have excess cash that you're sitting on, to make sure that you stay within those FDIC levels. And also, Eric the point about systematically important bank, i.e., is it too big to fail? That's a great question. I mean, there's a lot of banks that we deal with, like PNC and M&T, Wells Fargo. They're very, very large institutions that are going to be more risk adverse, if you want to put it that way. They're going to take a less risky position on things that because of how big they are, making sure that maybe utilizing the ability to work with some larger banks and smaller banks, it may not be a bad idea in regards to taking advantage of FDIC insurance levels, and also just diversifying your portfolio to reduce some of that risk of failure.
Yeah. Now here's another interesting point, Dave. Is something I've seen recently is banks and interest rates right now, what they're at, and uncertainty with interest rates going forward. What I've seen is banks are a little more hesitant to lend out in transactions. They're tightening up their lending stance, and what that can do is that can delay a transaction happening for a year or half a year, and that can negatively impact your return that you're going to get, because who knows what the situation is going to be like 6 months from now. It's a general tightening. There's used to be a lot of money out there available when it was relatively free money with low interest rates. But as interest rates have increased, it's not so free anymore, because banks have to look at their portfolio. They have to look, and they can't put themselves in a position where it hurts them too much to be lending out at the higher rates, to some degree. They're just a little more tighter with their money, and I've seen that. A recent transaction, from this past year, there were less interested banks than we had thought there would be when we started the transaction, and that was just because interest rates are going up. So some of these economic factors can impact, the ability even to, have a transaction and to sell your business.
Yeah, basically, bottom line, Eric, is that a lot of these banks and credit unions are, they're really getting more and more disciplined with their lending in regards to their lending requirements, just to be able to hedge against some of these portfolio issues that they may encounter in the future, if they hold a lot of commercial real estate, or maybe they hold a lot of residential real estate. Could be a little bit different, but those portfolios, so they're getting much more disciplined in regards to how they manage their portfolios.
No, I agree. Okay, now we're ready for the next slide, Dave. This is the big one.
Question number 4. All right, this is Eric Blocher. According to me, Dave Blain, who is the greatest Colts quarterback of all time? So, I actually had to have a conversation with one of our staff one time here about, the Colts used to be the Baltimore Colts, not the Indianapolis Colts. So, anyways, Eric, which one would you go with?
Oh, you know who I got to go with, Dave. I have a little bit of age on me, so I'm going a little bit older school, and I'm going with B. I got to go with Johnny U.
Yeah, Eric, I got to tell you, even though my son's name is Peyton, and I got the utmost respect for Peyton Manning, Johnny Unitas is still the man. Still the man. He revolutionized the position in an era where they didn't throw the football. You know what I mean? So Johnny is the man. Johnny is my guy. So that's who I would vote
You know, I contemplated going even older school and putting Burt Jones on here, but I don't think too many people besides you would remember who Burt Jones is.
All right, let's see what the answer is. Oh, Peyton Manning, he's 64%. Well, there you go. There you go. So Peyton Manning, nothing but the utmost respect for that guy. So.
Yep.
All right, well, Eric, I think we're at the end here. Let's open it up to see if there's any questions that that may be coming in. You know, Eric, one question that is coming in is that I saw was related to going back to some of our value drivers, and you know, would you consider the question had to deal with? Let me look here real quick. Question has to deal with if you had multiple lines of business in one of your business, if you had multiple operations and you had multiple locations that where one location was not profitable, but you didn't want to leave that market area because you didn't want to keep your competition the ability to penetrate that market area, what would be our recommendation there? Would it be to still look at from a financial perspective the cash flows of the business, or do you look at it from an intangible perspective of even though we have a loss scenario in that market region, we would still want to keep it because it keeps our competition from getting into that market?
What I would do then probably is I'd model things out. I'd look at the cash flows. I try to model it out and see, you know, here's where we are right now. Where would we be if we would leave? Where do we think it would be hurting with you know, our revenue and our bottom line in C? Because if you move out, you also reduce expenses. You might be better off with less, and then possibly look at an option. You know, could we still cover the area without having a plant? Could we you know, increase our distribution capacity where we could cover the sales in the area and just not have to supply it from there? I don't know. That's one of the options I would look at. Okay, here's a question we had coming in. How do you account for underbilling in the cash flow conversion factor? Well, if you think of it this way, underbilling, you know, the cash flow conversion factor looks at a period of time. So if you've underbilling at the beginning of the period, you most likely have underbilling at the end of the period as well. And it'll impact the cash conversion factor if there's a material change between those two numbers. But if you have it in the beginning and you have it at the end, the impact, I think, would be minimal to the cash conversion factor when you're looking at it, because, you know, the first one will change it, but then at the end of the year, you'll change it the other way. And so you'll have more billings that you received in the current year that you should have gotten last year, and you'll defer billings from this year into the next year. And the impact could be immaterial. But you'd have to see what the difference is between the change in the year.
Well, Eric, I think we're up here against our time at 3 o'clock, so I'm going to go ahead and do some closing remarks here as we are at that time. We're at the witching hour, right? So I just want to thank everybody for joining us today for today's webinar. If you have any further questions regarding today's presentation, feel free to reach out to me or Eric. Our team would be happy to assist you. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CP, and I'm hoping that you did all 4 polling questions if you want CP and answered the polling questions, those certificates will be sent out within the next 2 weeks. Keep in mind, we have another webinar coming up here on April 25th. High Trust. I'd assume that's Dave Hammerberg. Is that who it is? Is that Dave Hammerberg doing that High Trust webinar? I would assume it is. Can't wait. His office is right next to mine, and I can hear everything he says right through the wall.
Is leading that webinar.
Keep in mind also, Collaborate 2024 is coming up here. Registration is now open for Collaborate. This is our 10th anniversary leadership conference, which will take place on May 2nd and will again be held at the Penn Harris Hotel. And we also have an early bird discount. The early bird discount, Eric, if you register before April 2nd, and also get additional group registration discount by registering 3 or more people from your organization at the same time. You can't beat that. I mean, so we got some great speakers coming. I
think a group discount increases your cash flow.
Yeah, I think so. I mean, yeah, absolutely. So take advantage of that early bird discount. So I'm going to leave it at that. It's 3 o'clock. I'm going to thank everybody again for joining us, and I'm going to say enjoy the rest of your day.
Yes, thank you.